congratulations, and then we'll jump into the next one when we do that. And we have a lot to do. So, I noticed something from almost all of you, other than maybe one, in terms of the assignment. And it was, you all did a very, for the most part, you all did a very, very nice job. So congratulations on that. However, there was a little bit of a disconnect. We were telling a story when you're making a presentation like that. You're sharing information that completes a story. So you have to connect the dots, so to speak. No, we're just talking about the last assignment. And I felt like there wasn't that connection that a lot of you missed in connecting the data to translation into an investment strategy. And it's hard to do. So I was more generous in a way with the grades because I fell short in not teaching you that. So I graded myself. And ding me. So I want you to be thinking about that it's not just about a collection of data, but it's what is the data, we're doing it for a reason. What is the data telling us? And how do we use that data to be smarter and therefore better investors than someone who doesn't know to go collect the data? So that's what I'd like us to be thinking about also for the rest of the class and how we look at the information that we gather. How do we use it or interpret? It's like it's really a translation. It's taking information and translating it into an opportunity for investment. Does that make sense? Okay. So we should talk about that more. And as you have questions about it, just raise them to me, and I'll make more notice of it as well myself. So, what did you guys learn from this assignment? From analyzing? You underwrote I just with someone who said, "Well, what do you have them doing?" I said, "Well, they underwrote a country." So that's not an easy thing to do, and yet I think for the most part you guys did pretty well. So what did you learn from that? What was that? Good, bad, and bad is okay.
There's a lot of information available, and especially given like a week timetable with other stuff going on, it's a limited amount of time to go through it. But there's a lot of information, and what you also have to acknowledge is that sometimes a lot of the information is going to point to one strategy, but you might have one or two pieces of information that point the other direction. You kind of have to choose to sift through what you're going to focus on and what's going to kind of drive your decision, because it's not going to often happen where every single data point you look at points to one exact strategy in one exact place. So it's kind of prioritizing and deciding what's going to drive that decision-making process, what you focus on and what you ignore.
So, okay, that's a really good point. So first of all, so you're all editors essentially, because you have a lot of information and you have to take that information and edit it down to be able to support, or be able to edit it down so that it tells you what the strategy is. And then you can also get very easily, it looks one way and the information's telling you to go one way, but yet it seems like maybe you need to dig deeper. And that's what we were talking before about emerging markets. Like just looking at the current moment in time can be incredibly misleading in terms of, I think we're talking about Brazil specifically, that the currency really has been a tremendously volatile currency. But if you look at just now, it doesn't look so bad. So that shows you that you do need to dig a little deeper sometimes to get the true story. Okay, good. What else?
I just had a hard time because I personally wouldn't invest in the country that I was assigned.
Yeah.
So it was hard to kind of come up with counterpoints. And when you have that bias, like kind of going into the information is kind of telling you not to, but you're trying to still get their money, like you're trying to still get them to invest, especially when you probably wouldn't if it were your money. So I mean, I had a problem. I found a disconnect with that because I personally wouldn't invest in Japan, but I had to find reasons to invest. So I found that bias, like kind of getting rid of that bias hard.
That's a really, really, really interesting point, because that's real life.
Yeah.
That's what happens.
Mhm.
You have to go in and make and find a reason to do what some other people have decided to do.
Mhm. Yeah.
And that's not so easy. So that's a really, really good point. And it's, so sometimes it's finding the best opportunity in the worst situation. If that makes any sense.
Yeah.
Austin, would you like to say something?
Yeah, I think sort of on the flip side of what you were just saying before, Anmol, I think it's definitely important to do a deep dive, but at the same time, a lot of times it's amazing how much you can find out just by looking at sort of the current state of the country. Like for India, I had no idea going into it that half the population was under 25, and to me that just really stuck out from the get-go, and that was sort of a trend that we couldn't ignore, along with this rise in tech and all these other factors that are happening on the ground right now.
So that's a really good point that Austin brings up, that you can see some sort of headline issues and it could drag you into a direction, but how much faith and how much credibility do you direct just to those points? So part of it is you start to learn and to see what the data is telling you, and it guides you, and then you're able to stand back. But you can get sort of swayed into different directions that maybe aren't really accurate. So it's learning to discern, be discerning, in terms of what the information is telling you. So it's not easy, and it just takes time. And the more you do it, the more facile and you realize what the information is telling you.
Yeah, and it tells you your analytical factors as well. Like you identify key industries, and when you are suggesting the asset class that you're supposed to invest in, you can it takes an analytical brain to figure out what are the top performing industries and how do you connect them in terms of real estate. That was very key, I thought. I mean,
Right, looking at industries and how does that impact.
And predicting where it's going to go.
Right, because that's what we're all doing,
Right.
we're predicting things, so.
I struggled with China with the sheer amount of big growing markets that were to be considered kind of like prime markets everywhere else. It's not necessarily overly difficult to go to the UK and say I'm going to invest in London, or come to the US and say I'm going to focus on core in Manhattan. But when you're looking at the secondary markets, and there's, I'm making this number up off the top of my head, but 20 cities of 4 million people or more with growing populations and growing economies, it's a lot to look at, and there's kind of only a few countries that fit into that mold. But you can make the same argument to a lesser extent about the US if you put those kind of top couple cities outside that, where those secondary cities, like where do you invest? It takes a lot of information, a lot of research to kind of weed through that next tier of cities once you get past the country level.
But there's also, I think, we all come to any project we do with our own bias, and I think that's a piece of it, because we have, like, remember, so Austin just said, so he was so shocked that India has this incredibly young population. So you wouldn't have known that otherwise necessarily. So we learn things, and part of it is, again, this discernment, and then sort of saying, okay, and it's almost, you can start to set a table of metrics, like what I've asked you guys to do, doing it, to look at measurements of things, and to set a scale to be the cutoff. So when you are approached with a place like China, where you have, all these cities with millions of population levels, maybe you pick some other GDP, income, per capita income, whatever, and you start to say, okay, this is how I'm going to then start. Because you also, have to think about in investment programs, you have to ultimately defend it to somebody, right? Unless you're using your own capital, which maybe, but if you're not, then you have, even if you are, then you wanna go get a loan or whatever, you still have to defend it. So you have to be able to be very rational about how you're making these decisions and how you are structuring the process. And it is a process. So, okay. All right. Anybody else anything? Okay, so, all right, so today, a few things. We're going to go over the next assignment. I sent out, I forgot to do it in the first one. I sent out the second one, the group of teams again, and I did teams for this one. I took a, NYU offered this, teaching seminar. So I figured, okay, I'll go learn something. And one of the things, and there's a panel of students, and they all said that they learned more and got more out of things when they worked in teams. So I'm like, okay. I mean, seems logical. So I assigned teams.
The teams was fun actually. Like, you know, you're getting two perspectives on the same
Right.
objective.
Exactly, and it's like you're not just sitting in your own head.
Yeah.
It's more conversations. I think we learn more that way too. So, all right, so we'll do that. So I'll go over the assignment, and as always, any questions, whatever, as you're going through it, just let me know. And two other things today. We have a regular presentation to go through with you about investors and investment managers, so more the landscape of the world, of how that works. I think we need to understand. Nobody really talks about it as much, they should. And I also brought with me, I have a presentation to a pension fund from an investment manager investing into an Asian fund. And I was like, that will probably make a lot of what we're doing come to life a lot more. So I think we'll spend more time on that today. Warren, you're all nodding, so that's good. And then next week, we have a guest speaker, so I'll be quiet for most. And he comes to us, he was originally at New York State Common. So New York State Common Retirement Funds is I think it's the second largest pension fund in the country. And he was one of the real estate investment officers there. He's no longer there, which is why he's with us now. And he has a presentation on a self-storage investment that New York State Common did in Europe. It was their first investment into Europe. And it's quite a fascinating story. So I think you'll find that quite interesting. And he's a very approachable, very nice guy. And I think you should feel free to ask him questions and push into it and really try to understand from you have a real investor standing in front of you from a pension fund, one of the largest. And they are one of the most, I'd say, structured pension funds for real estate in the country. So he has he'll take us through their process with things, so. Okay, any questions or any thoughts on anything else? I mean, we're almost done, I'm like, so shocking. I mean, I know we missed a class. Do you guys want a makeup class? Should we try to structure something? Should I send out dates or something? I can ask to get a room. I mean, we could use it for a number of things. If people just want to talk about some of the past assignments, yeah? Okay.
I feel like the biggest challenge will be getting everyone together at the same time, but I feel
I know.
like we've done it in a couple other classes. Generally, you can get like 3/4. That's kind of the most
That's
you can
enough,
hope
okay.
for, just because
Yeah.
it's pretty.
Okay,
organized classes.
so what I'll do is I'll arrange a classroom in the next few weeks, and I'll send out dates and see whoever can join, can make it. And if not, if you can't make it and you wanted to spend one-on-one time, let me know. I'm always available for that. Okay. So this assignment is a continuation of the other two. In that what you're doing now is you're actually putting, of course, going to have 250 million US dollars to invest into a global real estate portfolio. Okay? And so here are your questions. How much, and I give you, we'll go into the next chart in a minute, but essentially it's what is the allocation for each region? What returns can you get from the region? Also thinking about risk and rewards, so volatility, Sharpe ratios, all that kind of good thing. Which sectors, retail, industrial, residential, etc. What returns you expect per sector strategy, and where is the return coming from? So that's gonna be a conversation we have yet to have, and we'll discuss that in a minute, okay? And is this for higher returning strategies, or what is the investment rationale? So while I give you two or three charts to fill out, you might want to defend that with some backup. Don't go crazy, it doesn't have to be 10, 20 pages or anything like that, but you might want to provide some backup in terms of how you were thinking and why you did what you did. So you're going to present your portfolios and you have to defend them, and we will ask questions about how you made your decisions and how you came to your conclusions. So again, here, keep in mind, it's not just the presentation of the data points, it's your interpretation of what the data means and how it's going to look like in a portfolio. So, can you see it? Okay. So, these are the charts, and if you want to play with it, you can, but make sure you at least give us this information, and you don't have to make anything more. You're not going to be graded on doing fancy logarithms or something. All right, to be very basic, you're going to determine the geographic, the sector, the subsector. So in other words, power centers, malls versus medical office, etc. And then revenue sources, we'll talk about in a second. And then you're going to lay it out in, and this is something I actually did in real life. Okay, not in school life. Not that school life is in real life. So we're going to look at how we're getting to our returns, what the weighted averages are for the returns, how you allocate for the whole portfolio, and how, so this is essentially modern portfolio theory, broken down into a real estate portfolio, into sectors, and then looked at what's contributing to what, okay? Revenue sources. Okay, this is the one piece that I said we haven't really discussed. So, if you think about a return, forget about that for a minute. Think about a return that you're going to get. How do you get your return? Where do you get your return from?
Income and appreciation.
What else?
Taxes.
All right, putting that aside.
Maybe some services offered as part of the running the building.
No, so it's tied. That's just a little bit of a trick question. So it's tied to the appreciation. So how do you get appreciation?
Value of your asset goes up, and you realize it upon sale of the asset.
And what else?
Based on cap rates.
Okay. Someone could be not the smartest investor in the room, and they could go buy a property. They could do nothing to that property. Right? You've all seen this. And yet, they could end up making a 3-4x multiple. And it's not because they were brilliant, it's because the cap rate moved, the discount rate moved, the market moved. And I want you to start thinking about that, because that contributes to the appreciation. So it's not just because you grew the NOI. So it's important to think about where you're getting your return from. Because I will tell you that a lot of people will buy properties expecting that to happen.
Risky strategy.
I can't, yes. So, point is, we need to be, as smart investors, to be discerning, to figure out where we're going to be getting our returns from. And we are now, all of us, in an environment, so they just dropped the Fed just dropped the rates another 25 basis points today. So we're in a very low interest rate environment. Cap rates are low to begin with? Do we think there's room? Somebody said here, one of you guys, I forget which one now, said that they were expecting to get, and I think I put it in my commentary, you're expecting to get cap rate compression. And I was like, well, from where, like, why? And it could just, and the right answer could be, we just think that discount rates are going to move again. And that's okay, but you need to think that through. You're not investing in a vacuum, you're investing in a whole world, an environment, and it all comes into play. So I want you to be thinking about where you're getting your return from as you're putting your portfolio together. That's how you're thinking about where your expectations for the return. So remember, it's $250 million US dollars, and you're dividing it up into these different regions and such. And you could use some of the work that you did before to defend why you're doing what you're doing. And we're going to just next time, I think for the class, it's not due for 2 weeks, so you have time to think about it. But we'll probably just do it, we'll sit around the table, and whoever wants to put it up, and so we'll have more of a lively conversation about how this all works and doesn't work, and what you struggled with, and what you're thinking through in terms of returns and such.
Two questions. The first one, do you just want us to submit this kind of as the same thing, a PowerPoint with rationale that you could follow without us explaining it, and then we can also walk through it in the class?
Well, you should explain.
No, I mean, like, you could read it without us there, like when we send
Yes,
it to you.
exactly.
Like, it's not something where
Yes.
we don't talk to it, doesn't make any sense.
And that's a really good point, because no matter what, whenever you're submitting something, it should always be that it stands on its own, that you don't have to be there. It's like paintings, you go to a museum and they have to have like an explanation. It's like, really? You know? So it's the same kind of thing. So always have whatever material you submit to anybody, make sure it's just communicating the messages that you want clearly, succinctly.
And then I have one other question on the revenue sources. So I just wanna make sure I understand it properly.
So I broke this down into three.
So for example though, so we had like my expectation for a lot of assets would be if you're gonna own it for the next 5-10 years, I would expect cap rates to stay the same or if anything to be going up.
Okay, so your economic indicator is.
That would be.
Right, so but what's an economic indicator? It indicates where the economy is going.
Yeah.
So basically.
My point I guess though is like if for example, if income grows, that would result in the appreciation of the asset, but would that be factored into the income section or into appreciation upon sale?
Separate. I'm getting you to pull the pieces out.
All together.
Right, I'm getting you to look at all the different elements individually and to think about that. Because that's ultimately what creates value. Each of them in spite of each other, distinct from each other. You can have an economic indicator movement and not have in this example, and not have, you'll have appreciation, but you won't have appreciation in terms of how you would think you would get appreciation because the value of the property is going up because you did something.
Yeah.
This is more just the economy is doing something, that you're using a different discount rate or you're using a different cap rate to value a piece of property. So if you go into a marketplace, let's see, so if you go into Vietnam, let's say, has really high returns, and you expect that's going to go down, that would be a very big impetus in terms of where your return is coming from, as opposed to you buying something in an opportunity zone someplace, in New York, and you're doing a lot of work, or you're buying like my property is a value-add property, I'm gonna do some stuff. So that's how I'm going to create the value. So it's the same kind of thing. You also look sort of pensive.
I have one more question, hopefully the
Go
last
for it.
one.
No, you get more. You're not limited.
In terms of like kind of breadth of detail for backup here, like if you wanted to, you could do 10 pages on urban office on Europe.
Yeah,
alone,
no,
right?
don't do
Obviously not, but I mean like kind of in terms of backup of, are we talking kind of high level, like here's the expected returns from CBRE and JLL, the US economy is generally declining, like that kind of
Yes.
level?
High level.
Okay.
Yeah, you don't have to get into the weeds. So the next, there is another page. And it's just the subsidy allocations broken down in the same thing. So yeah, so in terms of the backup, it's just yourself sitting here, having to defend what you put down. And it's those key points that you will want to access or highlight to me that why you made your decisions. So again, it's thinking about where you started out the conversation initially by saying we need to be able to translate what the data, what the information, what the research is telling us into an investment strategy. This is it in bold lights.
Do we have to are we going to have like a target return or like a base return? Because like higher return will be like 20%,
Yes.
25, 30%, like
Return hurdle.
So I think I said in here,
It's a core portfolio.
right, where did I say that?
The last sentence in the first paragraph. There's no rate, which says core.
Yes, there we go. Tables of, oh, no, that's what I did.
Oh, I thought that's where we're
No,
gonna.
the tables are currently
Oh.
being for a core portfolio, so don't look at my numbers. I mean, it's an example, but,
It is on the second paragraph.
yeah.
Next.
Yeah, I thought I did opportunistic.
Subsector returns.
Whatever, let's say something. You can choose, so if I don't say, well, what are these different terms, what is?
Just pick a strategy and justify it.
Yeah, so here, what is the opportunity for higher return strategies, what is the investment rationale? So you can decide, sitting here today, November 2019, thinking about the world we live in, what do you think is realistic? You're doing a global I want you to do global, right? Don't just do all US. And think about, so I want you to put the numbers together and think about balancing a portfolio.
So is this kind of like building off of our collective last assignment, how we looked at each country and then taking that into consideration to target?
Well, you're going to do more regions.
Higher level than the
Yeah.
last one.
What's that?
It's higher level than the last one. You're not gonna dig into each
Right.
region as much as we did for the
Right.
last one.
Where we're taking all those presentations in mind and then picking a couple of regions.
Right, so what you're looking to do is create a global portfolio and balancing it, thinking about what kind of returns you want and need and where it's going to be and why you're going to make certain decisions and target certain returns. Like you'll say, again, you're a pension fund investor, so you want, and you can even pick one if you want, but just essentially you want, let's say, core plus or value add returns. So let's say you want 8 to 9%. You can do ranges also. You don't have to pick one number. So let's say you want 8 to 10% return. How are you going to get there in this marketplace? That's really the question that you're asking yourself. Pick a sweet spot that you think is achievable, and then say, how am I going to get there using all the different asset sectors? How are you going to break it out? Where are the returns going to come from? And which regions are you going to get them from? You look very confused. You okay?
Oh yeah, I'm just trying.
No, I'm saying to you.
Oh.
Yeah.
Yeah, you good? Okay, you look very good. All right, so that's the highline question, right? It's like a puzzle. But now that you've underwritten the countries, you can sort of start to think about what made sense there. Then remember, first what we did was we looked, you can go back to your first assignment, say those countries were going to potentially produce X returns, right? Based on all the risks and everything we were looking at. So that could very well be your entree into here. It's fun, actually. It's a good exercise. And let me say, there are no wrong answers in any of this. I want to see the defense and the thinking, the translation, what I started out the whole conversation by talking about. That's what this is about. So I'm not gonna look at this and say, oh, you didn't get, 10, 12, whatever.
one more question. Going through from geographic focus to subsector focus, so looking at urban office, for example, you went through and you allocated a percentage to each region, and then at the end of that decided to allocate 0 to those regions in the first place. Is that how you, I'm not saying it should go left to right, but is that generally how you look at it? Like, look
You
at
should
every
probably go from
single
left to right, yeah.
market, and then at the end of that decide, okay, if I was to invest, I'd put 40% here, but I don't like this sector at all.
Right. Mm-hmm.
If you go into it though, and I say, like, as I'm going through it, I haven't decided my breakdown between the countries, I just decided this asset class in general is terrible, is there any point in breaking it down between region?
You don't have to use these asset classes. None of this is fixed. I just gave you what I did.
Your example.
Right? You don't have to use any of this. But don't tell me you're going to just do one thing.
No, of course, I just meant, the
Right.
first one was an example because you ended up allocating 0, but it's still
Right. It's
on there.
that's fine. And you can say, and that's fine, you can say, just show them what you thought about it.
Why?
Yeah. And then you can show the returns in Europe on average, you know, and you can look at either the public markets and the private markets. You can use some of the data that we've been talking about in terms of returns to substantiate either why it's in there or why it's not in there. Right?
Great.
Like stocks, right? Like you wanna hedge certain risks by offsetting it with less risky.
Right, well, that's right, so, right, okay, so would it be wrong to say, okay, I'm a pension fund, I need to invest in real estate, I need my actuarial return is probably, it just went up, so now it's like 8 to 10%. Oh my God, so I can't do core, I'll never get there, right? So maybe you say, okay, I'm doing an opportunistic portfolio, and I'm going to really shoot for whatever you shoot for. And I'm going to go into primarily the region in the world that has the largest, highest returns. I'm taking the highest risks, or maybe you totally barbell it, right? So you have total core, very basic stuff, married with very high-end stuff. And then hopefully it comes out in the middle. So that's another way of looking. So there's lots of ways of doing it. And you could, you know, what you could look at, and we're going to go through one today, and so that maybe we'll do that first. What you could look at is look at some of the other pension funds that are out there. I told you can access their portfolios online for the most part, and you can see what they did. And you can pick one or two and just sort of take a view in. And you can either mimic it or say, no, they're really pretty stupid, that was really dumb, and move on. But that's an idea. Because again, that's real life. Now, you'll have to still defend it. Don't just come in here and say, well, Pensers did this and they're brilliant people, so, you know, that won't fly. Okay? So again, you can email me with questions. If you want to talk to me, let me know. And next week before his name is David Tepperman, before David starts speaking, we'll spend another 5-10 minutes just to go answer any other questions that you might have. Okay? So, all right. So you want to jump into the presentation that I brought from this other, you want to do that first? Okay. Okay, so this was LACERS, Los Angeles City Employee Retirement System. So remember we spoke about CalPERS, so that's California Public Employee Retirement System. This is the LA. So it's very likely that some of it crosses over, and they might have some of the same people in both plans actually. It's a little confusing, but anyway, so this is a city plan, Los Angeles City Employee Retirement Systems. And look what they said. So this is an actual presentation that was done, okay? And they have a commitment up to $25 million. So Heitman, we'll learn who Heitman is in a minute, called the Happy Fund, which is a chunk of that, in their Asia Pacific Property Investors Fund. So, the investment manager walks in the door and says, I'd like to get, because I have a strategy to invest into Asia, and I need money to do it, and I'm coming to these pension funds, to access capital so I can do it and earn my fees. That's essentially what it says, okay? So there's a board. So you have staff from a pension fund whose daily job is to manage the assets, make investment decisions and things, but they have to get permission and they make recommendations to the board votes on it, and then it becomes enacted. Now, the board for a lot of these pension funds, interestingly, are made up of people who were workers, employees for these pension funds. In other words, Los Angeles City Employee Retirement Systems would have teachers, firemen, policemen, people who work for Los Angeles City. Guess what? Most of them don't have any financial background. And yet they're making these investment decisions. So sort of just keep that in mind. That's really pretty interesting. What they also do is they hire consultants. Okay? So what that means is that the staff doesn't take essentially a lot of responsibility that would normally go to an investment professional is pushed off to this consultant. And there's a whole industry of consultants. You might have heard of some of their names. Towers Watson, Townsend, Mercer, and what they do is they come in and they opine on how much in returns should be gotten, which investments they should do, et cetera, et cetera. And they act almost as like a buffer. Because a lot of times the pension funds they're not paying the investment professionals to get the best of the best. So because they don't have that many resources to pay, they use these consultants that don't get paid a lot either, but it's a whole industry now that's blossomed. And you guys go work at a consultant. I mean, it's a viable opportunity. All right, so we have, in this room, you have three sets of people. You have the Lacers employees, you have the consultant, in this case it's Townsend, I think? Oh, look at a minute, I think it's Townsend, and then you have Heitman, who's the investment manager. Okay, so let's look at who Heitman is.
How do they keep the consultants accountable for hitting their trajectories?
They get fired.
Oh.
And
There's
their,
a lot of movement of consultants.
and their conflicts of interest. Say they have another. I mean, if the
That's a
consultant.
really good question. So what happened was Townsend's has been the largest real estate consultant in the US. And Townsend went and started what's called the fund of funds product
Mhm.
themselves. So instead of just advising which investment products to invest into, they started their own fund where they were going to get fees based on performance of these other funds. So the fact that they were then advising clients supposedly independently, but yet putting them into the same fund that they would then be getting fees from, some people
Yeah.
thought that was definitely conflict.
And in 2007, BlackRock was advising CalPERS, and they were putting them into some of their own deals, and they eventually thought about dropping them. I know that whole Stoytown deal, there was some serious conflict of interest there because they were the advisor and basically telling them to do this deal, but it was their deal, so
A lot of
serious
problems.
issues there.
Right. Huge issue with this whole, and this is the biggest world of capital for real estate, globally. And along with sovereign wealth, so we'll get to that. So, now what was interesting here is that, so his Lacers had invested into a Heitman fund. Where is it? Excuse me, sorry. Okay, so Townsend is recommending the investment, and this is 2016. Now, so here's Heitman. So Heitman is a general partner. They're the ones that create the investment strategies and go invest and do all the work. They have, at that time, they have 11 offices worldwide, so they're huge. $37 billion of assets under management in real estate. Heitman only does real estate. They're out of Chicago. They're good guys, actually. So, and they have someone that's running the whole Asia business for them. He's been there for in Asia for 20 years. And he's an American. Okay? So you sort of get the lay of the land. Now look at this. Lacers previously gave Heitman in a U.S. fund $15 million back in 2004. The fund dissolved in 2015, so it went through the financial crisis. But they only ended up with a in over 10 years, they only had a 1.3 equity multiple and a 4.9% net IRR. And yet these guys have the nerve to walk back in and ask for more money. Just saying. Okay? Okay, so here's their strategy. Here's Heitman's strategy. Invest in real estate opportunities in Asia Pacific, primarily Australia, Japan, Hong Kong, and Singapore. Okay? And office, industrial, retail, residential, and special property types, self-storage, student housing, medical office. So across the board, but in what I would call developed Asia, almost.
Yeah.
Right? Okay. So the fund itself is going to be a $250 million fund that Heitman is going to raise. So they're running around the world now speaking to all these pension funds trying to get multiples of these Lacers, 25 million. Maximum 350 million of equity. So that's equity. So you're looking at $1 billion to put out, plus or minus. Okay? Lacers has 5% target allocation to real estate, 741 million. 5.8%, only 5.8% funded. Their liquidations, blah, blah, blah. Okay, so 25 million over 700 odd million.
What does it mean that their exposure to real estate increase? Is it like a liability?
No. So, well, I mean, yes, but no. In the sense that what they're saying is they have commitments that weren't funded. So they committed, like, let's say in this case, they committed $25 million to this Heitman fund. But you don't give them a $25 million check up front because it's going to take them 3 to 4 years probably to invest that equity. So your equity gets drawn down over a period of time. So you're not, so you commit, but you don't fund. So that means it's uncommitted, it's unfunded.
That's it.
Right? So there's always a drag. And what people look at in the marketplace is what they call dry powder. So it could be that all these managers run around like, you know, $20 billion fund that Blackstone does. How long is it going to take them to get all that money out? And that's just equity. So it could take years. So the dry powder is what's committed but not invested. And that's a really big, important point, because if you have a tremendous amount of dry powder that's out there, of capital that's not invested, that's committed but not invested, managers are going to start to make funky decisions because they're motivated to get the money out Because what happens if they don't invest the money by a certain point in time, if that's agreed to, they have to give the money back. And nobody wants to do that, because they've been getting asset management fees on that capital. So that's why it's an important number to look at, because if there's a huge overhang, then we want to look at how much capital is in the marketplace at any one point in time. And you should look at that when you're doing your portfolios. You know, how much capital is expected to be out there, how much capital is raised, how much capital is dry powder that's not invested, because that's going to say what kind of deals are going to happen. If there's too much deals, too much capital, the yields start to go down and start to compress.
Professor, does that accrue interest of any kind, the lying capital, the lying dry powder capital that is committed but it is not being drawn on our sources, on our users or sources?
What's the first part of the question?
The dry powder capital, it being stretched out
Right.
about when it is being sourced from like the fund or from
Right.
So the remaining, say out of the 25 million, 5 million gets drawn today, and like the next 20 million is drawn in the next. So the 10 million that is being drawn in 1 year,
Right.
does that accrue interest or does that accrue any sort
No.
of growth? Nothing with that.
Nothing.
So
So-
once it is committed, it is in the investor.
So the question is, here's the actual question to your question, is how do you calculate IRR from a
For
fund manager's perspective? Because you could be committing your capital to an investment strategy January 1, 2020, but you're not necessarily investing it until 2024. And you're not earning any income, any return on that capital. So that's a discussion in terms of when do you start the IRR clock ticking. Think about that, because that has a big impact. Because then also, as we see, these managers get paid their carried interest they promote based on hitting these IRR hurdles, which I would say is false, but whatever. And how do you calculate that? Because usually it's from day one. But to your point, it has a big implication in how the fund does.
Makes sense too, because otherwise they'd be incentivized to do quick short-term deals with really high IRRs that don't actually make that much money.
Well,
For the fees.
so it's still a problem.
Yeah.
Because you're right. So if you have this short little window and you're churning the deals, you're flipping the deals, what kind of return is it?
Time sensitive.
Right, time-weighted return. So the shorter the period, the higher the IRR. In my mind, if I were to rule this little world, it would be equity multiples. It should be. The investors haven't gotten smart enough to figure that out. And that's what it should be. But that's how much money you're getting back, how much money you're earning of and on your capital. So, all right, so here's where we are. So in the room, you have Townsend, you have Lacers, and you have Heitman. What are some of the questions we're going to want to know about from Heitman? If they're going to tell us this strategy, what do we want to know about them, from them?
Their profile, how their previous transactions, their previous everything. Yeah.
Right? Employees, track record, all that kind of, right?
Yeah.
And exactly right, Kash. What kind of deals have they done and what kind of track record? And we're going to go pull those apart. Because they'll tell you all sorts of things. Right? And that's where Townsend comes in. Okay, so here's Lisa's portfolio. So you see they have the target range. So this is like what you're going to do, right? So you have the target allocation. So the tactical is saying, like, where am I getting? Where am I going? Right? So it's somewhere in that range. And you see where they are. So the core portfolio is less than the target. And the non-core portfolio is also less than the target. And timber is like whatever. So, this is how they look at their world. Okay. So here's where they start to talk about, the fund targets a gross IRR. Gross, 14 to 16%, and net IRR 11 to 13. Do you think, excuse me, it's only 200 basis point difference between gross and net?
Sure, there should be.
Like seriously? Between the asset management fee for an Asia fund, we'll see what the fees are, but for an Asia fund, it's expensive to run an Asia fund. Because why? Asia's a huge region, and you have to have people in all these regions, or you're flying around, it's all expensive. So you're going to be able to charge probably 200 basis points in asset management fees for asset management alone, not talking about any kind of promote or anything else. Okay? And look, Townsend is putting their other clients in there. Okay, so Heitman is 50 years old. I just get to the. Okay, so here's why they're going overseas. Diversification, right? It's currently 5.7% diversified to 5, so it's a very small percentage right now that they have overseas. Only 1.2% to Asia. It's nothing. And the funds are winding down. Some of them, they're older funds probably, so they're going to have even less of an allocation to outside the US. They want this other sector, they want to be able to have these other kinds of strategies in their portfolio. Okay, so now Townsend's saying how wonderful they are. They're saying they negotiated all these great perks for all their clients. First close management fee incentive. So, I'm not sure what they mean. Oh, so what that means is if you come into the first close is the hardest to get because you want to, it's like for anything first. So they're trying to give them an advantage to encourage them to come into the first close. Because there's really no incentive for these investors to go into a first close. These managers have usually somewhere around, depending on the size of the fund, 3 to 4 closes. And again, when does your clock start ticking and calculating your IRR? You could wait till the last close, which is probably a year from now. So you're incentivized really not to go in the first one. Right?
Is it for the same $250 million? The 4 closes that they're going to. Okay.
Yeah. So it's slow. It depends how much comes in first and whatever. They're saying they got a discount to the Townsend clients. And so what does this mean? Higher preferred equity hurdle. So anyway.
It means that investors are going to get 10% before whatever group it is hits their promote.
Exactly.
So they're going to get so the benefit to them is that they're going to get more money before the sponsor gets anything.
Does everyone understand what Jarek's saying? You can say
Not
now.
really. Not really.
Go ahead. I can drink water.
So if
Say it differently.
if an investor is going to invest in the first close, then instead of the typical 9% that they would be almost basically guaranteed before the fund sponsor got any income, they would be getting 10%. So they would be getting 100 basis points more as almost like a guarantee before the sponsor got any money.
So is that basically the same thing that you were saying, that it's an advantage for the first round of closing? Okay.
All right, let me say it a little differently. So the way it's called a waterfall, okay? How everyone gets paid from the fund. So the investors get their money back first, right? Their equity that they put in. Then they have what Jared is talking about is a preferred return. So in this instance, it was probably an 8% normalized return. So what they're saying is you come in now with this, instead of an 8% return, you'll get a preferred return of like a 9 or a 10%. So in other words, the distribution after that is hurt to the manager by around 100, 150 basis points. Okay? Thank you, Chad. That's good. Oh, an advisory seat later gets. So there's an advisory board made up of investors, so usually the largest ones, and they don't make any investment decisions. So you never want another investor. You're not paying all this money to your manager for other investors to make investment decisions. What they do opine on are what's called like major decisions, such as if some catastrophe happens, or some insurance issue, or you have to have a change of manager or something. So they will opine on this board of investors that are like-minded investors will opine on things like that, but never on investments to make one. Now, but what happened though with the global financial crisis, all of a sudden you had these advisory boards having to make a lot of decisions that were related to investing or disinvesting. Should we continue? Do we need to put more money after bad money? All that kind of thing. So it got pretty, pretty tense. Okay, so here's the waterfall we were just talking about. So preferred return, so they're getting 10%, their money back plus 10% return. That's pretty good. It's not guaranteed. No one's gonna guarantee this. It's just preferred. And then this is where the splits are. So Lacers is a limited partner. They don't really have any say. They just their money is there, and that's it. Heitman, the investment manager, is the general partner. Okay. So the split after Lacers gets their money back, their equity back, plus the preferred return, then goes 85% to the LPs, 15% to Heitman, until 13% net IRR is achieved by Lacers. So, what do we say the IRR hurdles were here?
4% was there.
No, 11 to 13.
11 to 13.
Okay. Net, gross 14 to 16. Right, net IRR 11 to 13. So that's interesting. So the general partner for doing this business is getting their asset management fee, let's say it's 200 basis points, right? And then they're getting paid 15% of profits after the limited partner is getting not a high return, a regular return. So we said it was 14 to, it was, what did I say, net was 11 to 13. It's on the high end, but it's not like higher. It's what they're saying, that's their target.
Is it really that strange to say if we exceed our target, we want a little bit more? Like their highest end of their target's 13. They're saying if we exceed that by any stretch,
Don't
we
you
want
think?
a bit more. One question I had about this was there no catch up for the GP because of the way it's structured? Like, is that implied that there would be no catch up after the preferred equity return? Or it just doesn't mention that here? That's probably somewhere in the details. Who knows?
It's hard. We don't know. We don't know. And then they're getting 20%. So just think about that for a minute. Huh?
And GPs generally hold a very small part of the equity as well. Like they own 5% of the equity portion.
Well, okay. So in a lot of these instances, the LP, the GP, the Heitmans of the world have to put in some capital.
Right.
But they always complain they're poor.
Skin in the game.
So they put something in that's very, very limited. But this is not the return on that capital. This is just for who they are and what they're doing. But they put the strategy together and they're getting 15 to 20% of profits. Think about it. It's quite rich. This is what's called the promote, the carried interest. Promote equals carried interest equals whatever all the names we have for it. But this is how it typically works. This is typical.
Do you think this is unreasonably structured, or are you saying in general it's just quite rich to the guys who run the funds? Or do you think this specifically is kind of unreasonably generous?
What do you?
I don't know, I'm having a tough time reading. What's your opinion is here? Like whether it's just general, you think they get paid too much, or whether this...
That's snarky. So, I think it's ridiculous. This is typical. This isn't that, I'm
It's
not pointing at Heitman and saying bad. I
Generally.
like those guys, they're good guys. But if you think about it, what other part of the world, business world, would you get 15 to 20% of profits for not putting the money in? They're doing the work, and essentially when I see the target return, now we have to go see what the strategy is. It goes back to the question that I'm asking you to think about. Where's the return coming from? Because if it's just that here's the question. If Heitman does nothing, and the discount rates move, and the values go up in spite of them being the worst manager, should they get paid?
They shouldn't, but they will.
They will.
So do you see how important it is now to understand this? To see where the returns are coming from?
Do other entities within the real estate sector? I mean, like
This is life.
no, the developers come in as limited partners with the investment manager.
No. These are investors. These are
Right.
Sheet.
No, and then further diving down into like the specific sector, specific asset class, and they arrive at one single asset, and the
Are they just
developer.
doing one deal?
Yeah, like one deal in the portfolio of like deals.
Everyone's going to negotiate their own stuff. I
Right.
don't know, but
So-
this is traditional for the fund world, which, as we've seen, has this huge basket of mostly institutional real estate globally.
Right.
This is how it works. And is there a developer that then does a deal and says, okay, you want in? This is what I want. Of course.
So like each deal gets individualized and each.
Yeah, but it's. I mean, it depends. I don't know. But I would assume yes. I haven't seen that, but that doesn't mean anything.
I mean, their target audience is city workers, so I'm sure they'll get what they ask for.
So you're saying that lacers, because they are government employees, will just do this?
Should do.
Well,
Yeah, interesting point actually.
but in theory, the people who run the Lacers investment strategy aren't city workers. They're at least in theory supposed to be.
They're government workers.
No, well, but
Just
their
is,
job,
right?
but their job is to run the investment strategy. It's not the guy who's working in the city. Like his job is to run investments, not
Except the board, who makes the ultimate decision.
come up. But when they take advisement from the
So that's when you have townspeople,
Consultants.
consultants.
Yeah.
Do you see all this?
It's a service.
That's how it works. I'm not making this up. Does it make sense though? I mean, not does it make sense that they're doing it this way, it just makes them understand how it's working.
Well, one end you've got a lot of cash that needs to be allocated, they need to get returns for their retiring, probably high retiring staff.
Right.
On another end, you're paying
Exactly.
for their service, you're paying a markup because you don't have
Someone's doing it.
resources to do it.
Right. So you should pay, Jessica's absolutely right, you should pay for someone to put together a fund, an Asia fund, to run around Asia, finding deals, investing the deals, managing the deals, then knowing when to sell the deals to get to it is not insignificant work. That's a lot of work. A lot. And because of these are pension funds, there are way more financial reporting restrictions on all of this that goes along with it, which is very significant. And Heitman, I will tell you, is monitored or managed, whatever you want to call it, by the SEC. And they need licenses in these different countries at times. So it's significant work. But they're getting, what did I say, 2%, probably, on the 25 million a year.
So, for these IRR calculations,
Yeah.
aren't they only gonna hit those IRRs when they when they sell the assets or whatever they invest in?
Okay, so here's the other question. It's a good question. So here's what happened. originally when these funds started, it was, the calculation for this promote, the carried interest, was done each time an asset was sold. However, you get to the end of the portfolio, and you sold all the good ones, and now you're left with the dogs. So on a portfolio basis, all of a sudden, your IRR, your returns weren't as good as they thought. So that goes to the clawback kind of question. So most people, not everybody, most people got a lot smarter in terms of the investors and the consultants, and they said, no. Promotes, these carried interests are not getting paid until the entire portfolio is wound up and distributed. And that's how these are judged, not asset by asset.
Is that kind of how, like, when McGuire went under, they grouped?
Macquarie?
McGuire
Oh,
was like a big
okay.
real estate company that
Yes,
went
yes,
under.
yes,
They
yes.
grouped some of the bad assets and then sold it to the banks.
Well, the banks took them, they didn't sell them. They just took it because they defaulted on loans,
Yeah.
so they couldn't pay it and they lost their deals.
But you would like group them up.
Well, no, so what happens is, if there's income coming into a company, and, you know, it should be that each property pays for its own debt service and its own operating expenses, but sometimes, you'll see companies sort of commingle their funds to the point where they're paying, it's almost like a shell game, right? Thank you. So they're using some money from one asset to pay for the next one, and they'll pick and choose. Okay, want to pick the good ones. We won't pay for the dog, we'll let that go. So let's see their presentation, it's interesting. Oh, look, there's like a currency risk. What did they say? Yeah, so they just say it's there, they don't do anything about it. So here they show them also, here are some other Asia funds they could invest in instead of the Heitman. That was mine.
So,
So, there's my fund. Okay, so look at this. So this is how they look at their portfolio. Okay? So, I forget the timber. So look at these people. These are core investors, big time, right? And yet they're saying, okay, let's move and try to get some more, although it's decreasing their non-core portfolio targeted 40%, they're like way off. So the problem is going to be for the whole lacers. What did we say what the percentage was for real estate? Did we say that? I don't know if we said that.
It's 6.4%.
Is it total? Okay, and how big was the how big is the whole? Did we say?
I don't know if it actually mentioned that.
No. Well, the question is, so it's only 6%, but the problem would be if they're not having enough capital allocated towards the high return portion for real estate, it could be that the whole portfolio doesn't really come up to meet their actuarial returns. So this is a problem. They have to get money out into this high return sector to be able to, what? Pay, as Jessica was saying, the teachers, the firemen, and et cetera, et cetera. And here they're showing how they're looking at. So remember this? We spoke about the NFI Odyssey? That's the open-end fund that uses benchmarks. See, I didn't make all this stuff up. Right? So now you can see how they are actually using this to see where they are. And then they even break it down, mountains, southeast, and all this stuff. I want to get to these. I want to get to the, okay, so now it's Heitman's turn. So they're sitting up there in their suits, and they're going to do a presentation now, the lasers. Tell them how wonderful they are. So you have Skip Schwartz and John Mancuso. Okay, so Skip he runs Asia Pacific for Heitman. He's been there forever. I think he's at JP Morgan. And John is a marketing guy. Okay? Actually, no, he was from JP Morgan, I think. He was actually, I think, a portfolio manager. Okay, so this is what they call the happy fund. Many Heitman Asia Pacific investors, the happy fund. So this is their goal: create a diversified portfolio of real estate assets with a balanced income and growth strategy. So isn't that interesting? They're looking for balanced income and growth in Asia.
And what is balanced income?
They need balanced
Step.
income and growth.
Okay. Oh.
Same, right? So, this is 2017. And they're looking to go to Asia for income.
Great.
What's that?
I mean, that was when our economic growth was at its peak, I feel. 2017, 2018. So.
Right, but you would think that you'd be going there for
Appreciation.
the upside, the higher returns, right?
So this report's available online. There's a whole bunch of bullets from that page that are missing.
Page
No, the previous page.
Oh, really?
Like it was an executive. If anyone wants to look at it later, there's like a whole
Oh, you
summary.
found it?
I found it. There's a whole summary of
Oh, cool.
points. Just
Okay.
FYI for if anyone wants to look.
Yeah, you can go find all of this stuff. But the way you find it is not from the managers' sites. You go to the investors, these leasers and CalPERS and their sites, because they have to put everything online. Everything. You can even go watch one of the board meetings. I think CalPERS actually videos their board meetings.
That's cool.
So if you're ever doing a presentation, then you should go do that. Okay, so here's the Great Heitman. 50 years. So 50 years, 37 billion, 40 partners, private equity, private debt. So this is what? REITs, right? We're doing REITs. That's the 4 billion. 350 employees, 11 offices. They're big. You get the point. So here's what they're saying, that they have this global value add expertise. And they too start looking at the world how we've been looking at it. They're going to break down their portfolio. So they've had 1,500 value add properties, $20 billion, blah, blah, blah. So, and they were very big in self-storage. That was their big, they were early days into self-storage, and that's how they sort of got their start. Now, this is who their investors are.
And self-storage is different from 3PL, right? That's like
From what?
3PL is like.
Yes, yes. So here, most of their investors, so that 20-odd billion, right? So how much do they have now? 37 billion. But that 37 billion isn't all equity probably. Depends how, that's always the question. Are they looking at just, they're saying 37 billion managed across 3 complementary business units, so that I'm assuming includes that. So in actuality, we probably have somewhere around 12 to 15 billion-ish in equity.
Is it not in reference to the 33 billion private equity and the 4 billion public equity on the right?
Yes, but what I'm saying is, yes, and then the private debt. But what I'm saying is in the private equity, that 33 billion.
Well, of that, there's debt too. Gotcha.
Right, so I'm looking at just the equity piece. That's what I was thinking.
Gotcha.
So, and they're touting their value add strategy, which is great. And so most of their investors are from these public pension funds, okay? But they have corporate also, that's pretty big. So what is that? That's AT&T, IBM, whatever. These are the old, what's called defined benefit plan. Did you see that GE stopped their pension plan? It was in the paper like 2 weeks ago or so. What they said was, they have what's called a defined benefit plan where GE was giving dollars from their balance sheet to pay pensions going forward. said no more. That's, remember I explained that these corporations wanted to clean up the balance sheets, and the first thing that went in the pension funds. So that's why we have what's called the individual retirement accounts, or 401ks, where sometimes they'll match what you put in, the employer, but you're on your own. But that's where now a lot of these managers are trying to attract, because that money is, such a large pool of assets now, and everyone's trying to figure out how to access that in real estate, and it's happening. So, point is that these corporations, these are old plans. These are really old plans that haven't died. So, that's a risk. I would look at this and say, in my mind, that's a huge risk for them.
Because that's gonna shrink.
Exactly, shrinking asset class. So, something to just know. But look at the names that they have here. Oh, here's GE Capital, California State Teachers, Nomura. So they have European, Australian, Japanese. They have global investors. Oh, and here you go. So, but remember we said the most capital that's out there right now is from the U.S. So North America. But look how small pieces of the pie, the rest of the capital. Yeah, this is where the capital is domiciled. So what that means is where the capital is coming from. So this is 9% of European pension funds or corporation investors' capital that they've given to heighten to then go invest in a particular strategy. It could be U.S., it could be Asia, it could be anything.
For the foreign companies, will they be more reliable to sustain the corporate portion?
No, same thing's happening there. But it could be the public plans in Europe. And also, they don't have sovereign wealth funds. So that's really the biggest. Okay, so this is how their portfolio breaks down. Private equity, public equity, so it's what we saw before. And these are the different strategies that they've done. Core, value add, core, opportunistic, Asia. So again, in Asia, they've done these core funds. And this is how they've grown. So now they're going to demonstrate that they've been in Asia and they have this depth of expertise and what they've done. So these are projects that they've bought. And then the different types of breakdown of the assets of retail, industrial, and so. So think about, would you be giving them money right now for this happy fund? Here's people. Sometimes you see a lot of these Western managers go over there and they don't have any Asian people in the funds. It's somewhat amazing, but here they have a good strength of local talent, which is good. But they said that they're going to invest into, this is their process. Everyone always has these process charts. They all do the same thing, but it's how they identify opportunities. So, here, so this is where they're targeting. So the question is, if we go back, do they tell us where their employees are? Do they have employees in those areas? They don't even tell us.
They say beside their names, their office location.
Oh, it does say Hong Kong. Okay, they do. So they had Singapore. I don't see anyone here in Singapore. As an example. But look, see how they're starting to judge the countries, transparency, liquidity, market size? Which is what we've done, right? And seeing whether or not they're going into these different markets. And then here, So they're trying to then also build up and develop a portfolio. And how they're going to allocate it geographically. Now, you know, what they're saying is essentially it's going to be an office logistics retail fund with some residential and maybe they'll even do some debt. But again, their specialty has been the self-storage, so they're exporting that over to Asia now. I'm saying that's really what they're really looking to do is leverage off of what they know best, which is the self-storage business, and that's what they're really going to focus on there in Asia. My first question is there even a self-storage business in Asia? And is there a need for one? I don't know the answer. But, you know, I could argue in Japan, houses are very small, and I could see that, but they've lived without it, you know, I don't know.
And then this is saying that they would invest in all sectors in Australia?
Mm-hmm. Yeah. So this to me looks, it's too broad. I would have wanted to see a little more thought and detail in terms of, I mean, this I think is good. I think this makes sense as long as I understand that these markets, that there is student housing and medical office in, you know, is there student housing in, I don't know, in Hong Kong? I don't know. But that's what they're saying they're going to do. You know, part of it is a lot of these Western folks, they think that it worked here, so it will work someplace else, and sometimes it doesn't, sometimes it doesn't. It's very culturally based as well. Here's their investment thesis, okay? So here's what they talk about, their balance based on the term careful portfolio construction, core to development, sustainable income, improvements, potential downside protection. You know, it's great that they do this, but I'm not sure they're telling, did you really learn anything from what these words say?
Seem very obvious, a lot of it.
Exactly.
It's like
You could
buy
put-
mispriced assets.
Right,
Next.
you could put it in any presentation essentially, which is maybe that's what they do, I don't know. So, I wanna show you. So here's their pipe, so this is always interesting, everyone always wants to see the pipeline. So what they have to, what these managers have to do is they have to go find the assets, they don't have any money, right, cause they haven't raised the fund yet. So they have no money, they have to go find the assets and say it's a pipeline of deals. It's a little bit of smoke and mirrors. Because they have to convince someone to sell, to put aside this asset, cause we're going to get the money. You know, timing is everything. So that's always a very sensitive dance. So, like, okay, so this one, they actually executed a joint venture with a group in Singapore. All right, that's impressive. The rest of it just got LOI executed, that's also something, not great, but it's a little something, right? And then the other in discussion or in review, that's like, okay, they went to see a property.
I think a document like this would, like if this owner of one of these assets got a hold of it, could really impact your negotiation for the other office. They see exactly what you think the investment value and the equity, like how you're looking at their property. Like if I'm the owner.
You should be upfront. You can, you know, to really justify yourself. We've brought, in the past, I brought those partners in to talk to the investors. Doesn't get, you know, that's real. You can say whatever you want, and these people put all sorts of stuff in. So why value it now like that? So your question for your portfolio. So this is what they're showing. Recent upturn in key economies. China's economic transition underway. So they're analyzing where, you know, which countries have opportunities and which don't. But they did what we did, right? So per capita, per capita, middle income growth, household income growth, population breakdown. And then what are the drivers in these different markets? So here for self-storage, rising residential rental prices and small apartments making storage a lifestyle solution in dense cities. Okay. I mean, I can understand, it makes sense, but I don't know if it's if anyone would be bothered with it, I don't know. Hunt for yield continues. Okay, so this is what I wanted to show you. Look, this is what we've been talking about. This is exactly the building up of looking at returns, how to get to return. And they start with the 10-year yield, right? And cap rate spread, which we've been looking at, and then the NOI growth expectations, and then the leverage effect. Just look how much leverage you're looking into Tokyo residential. So this actually, I give him a lot of credit for doing this. This is really saying he's really looked at these different asset sectors and how we're going to get to the return. So, however, what's striking is if we go back and think about the waterfall, and they said that they were going to come in, their waterfall was coming in at around, after a 13% IRR, I think it was. So, most of the return, this very small portion of the return gotten from NOI growth is my point. Everything else, according to what their chart looks like, is coming from what? The economics, just macroeconomics. So I would have a very healthy discussion about that. Why should they be getting 15 to 20% profits? Well, they were smart enough to put the fund together, and then they ran around to go find a deal. That would be the answer, essentially. But they're only doing work to create, I don't know, 200 basis points or something of added value. Most of it's just coming from being in the right place at the right time and finding the right asset. But that's why you should always be thinking about connecting all the different pieces.
So on the first two, Hong Kong office and Tokyo Grade A office, they expect NOI to go down. Interesting. Okay.
So I guess they're thinking that tenants will leave.
Yeah.
Absorption's going to go down.
Yeah. Okay.
Yeah.
Interesting.
Yeah. I mean, why are you even thinking of going there?
Yeah. Right.
Diversification.
Diversification, maybe, I don't know. But you would argue. But they're saying value add alpha,
Yeah.
right?
Yeah. Weird. I don't know what happens.
But I thought that was quite interesting.
Huh. So I guess the Tokyo Grade A office will just expect to make all the returns on the big for on the cap rate.
Right.
Yeah. Which is like
So
kind of
when
like
you're
blue
doing your homework,
sky.
this is like what you're thinking about.
Yeah.
Well, almost a zero for Tokyo.
So Tokyo
So it's
sorry.
good.
Is Tokyo residential condos or apartment?
No. This would be rentals. Okay. Now, this is sort of a lot of the managers have gotten a lot of problems for having a very homogeneous staff. Because pension funds themselves are made up of lots of different backgrounds. So there's been pressure on the managers to diversify their staffs. And what first happened was the managers would show the people who clean the buildings. So then the investors got smart and said, no, break it down.
It's a lot of men.
Shocking.
We got that right. And here are our presenters, happy guys. So, I thought that was interesting.
Yeah. Very.
All right, take a little break, I'll put up, what time is it?
10 to.
Okay, so this is now to run some other stuff, okay. Any questions, comments, are you giving them money?
Need to do more research.
See on that.
Well, it'd be interesting to see where they are now. Oh, I bet we could. We can. If we go into Lacer's,
What was that?
because the towns have recommended to give them 25 million.
Can you pull
I
it
feel
up?
like you could never make a decision based on another company's presentation, because they're always gonna paint the rosiest picture. They're not gonna put in examples of their bad performance.
Well, the question is, how do you, I once did a whole analysis of a very large company, and you have to keep going and folding back and folding back and folding back, because how they present it is not
That's kind of what I'm getting at, yeah. They're not gonna provide you the bad details.
correct. And part of it is just even how they calculate an IRR.
Why is Australia so attractive? Because
Oh, think about
it
it.
seems hard because they have a lot of laws around waivers and it's just the dollar conversion.
But it's very good, though, it's very sophisticated.
Actually investment is crazy.
Trying to find their comments on here.
It sort of uses European law.
Yeah.
Again, it's in Asia. So, and it's large.
Investing in timber.
Population growth.
Yeah. Huge,
I mean, I know,
huge Asian population
come from,
right
like-
there and stuff. Let's come back at 8, okay? So, yeah.
Well, they did invest
I lived
with
there for a while.
Yeah.
The
They did.
real estate
In what?
in Sydney,
Heitman?
by the
them?
harbor,
Yeah.
is more expensive than
25
like
million?
Manhattan.
Is that Olympic Park?
Are they not the unhappy fund?
Maybe.
No,
Well,
it's-
yeah, there
yes,
was
it's
an
a
Olympic
happy
park
thing.
there, yeah. But yes, so it's like very expensive real estate.
So, we're just
Yeah.
reading the report from the end of
HEPI.
2018, the real estate report.
You found it?
Yeah.
Yeah,
Oh, so what did they do?
they
What's-
did invest.
No, they invested, but it says right here, it's they invested, and it says, they're talking about all these different funds they invested in, which is the one comment at the end of it says Standard Life Investments, European Real Estate Club 2, and Heitman Asia Pacific Property Investors were the largest detractors from the real estate performance.
Detractors?
Yeah. I'm sure there's more in there, I just control F Heitman, it's a long report, but that was the first thing that came up.
It's amazing.
So it says, for Heitman Asia, underperformance was due to J-curve effects in which management fees on committed capital represented a significant proportion of current NAV.
So what that means is, so the J curve is you're not getting your income until the assets are, right? But they're paying fees,
So it's eating up essentially all the
Return.
income.
right?
There's nothing
And you
left.
get hit because it's the early days in an IRR calculation. So that's why it's called the J curve. But they should have factored that in. That's not like news.
Yeah.
Look at their non-core portfolio over the years. The blue is their portfolio, and the dark blue is the NFI Odyssey.
That's so sad.
You're getting destroyed.
That's-
3.5% since the start.
That's so sad.
So they're the unhappy fund now.
So what happened?
So-
But the sad thing. So here's the really rough. Here's the really rough.
These are like teachers and other people's retirement.
Exactly.
It's not like
and the managers are still getting paid their 2% no matter what.
no, this isn't like, Mr. Private equity multi-hundred millionaire
No,
who
this
just
is the
lost
teacher,
5 million. This is
the fire person,
the policeman,
the policeman,
Yeah.
toll takers. There are such things anymore.
You wonder if Heitman's getting any more money from them after the last two.
Well, Well, look, they got it after the other one.
That's what I mean. I wondered, you know, if they come back for a third time, it's like, listen, we just need to reinvest in some of these properties. And
It wasn't our fault.
Well, exactly. It was the economy.
Right, stupid. But they said it was going to be the economy anyway.
That was what they were factoring on all their return from.
Right, that's what I'm saying. The fact that they showed that chart is so much,
I'm
right?
not sure whether it's like
They,
more.
because no one understands it. Now
What?
you guys do.
Yeah, I wasn't sure whether it's like almost insulting to show, or whether it was like extremely upfront of them to put it in there. Like, you know what I mean? Or whether it's like cover them, or what the
People
purpose
ask
of that.
for that, and the consultant specifically say, we wanna know where the return is coming from. So they need to do it, but the way they did it, it's like, seriously? Like, why am I paying you?
Yeah, it was like it's a value add strategy. It's more like kind of like the wait and see strategy or something, like just
Right, we have nothing to do.
buy
Moving our
and
feet
hold.
up, right. Right. It's a strange world,
It is
right?
very.
I agree.
But how did those like experienced investors and all the fund managers not see these red flags if if it's that obvious to us?
So, it's a little bit what Jessica was saying. So we saw, so Townsend told them, here are the 4 or 5 other funds you can do. You think it's gonna be that different in any of those funds? Right? However, what's been happening is the pension funds are starting to, like the very large, the sovereign wealth funds especially, which their money, and we'll talk about that, is from natural resources primarily, oil.
Right.
And they are starting their own funds. So they're, enough of you managers have paid, because you look at, they've paid billions of dollars, each of these funds, not collectively, each of them
Sure.
has spent hundreds of millions of dollars in fees to these groups in private equity, real estate, and whatever else, maybe hedge funds. And they've gotten nothing, like some of them they'll make them finally do, the fact that they haven't done it is, someone should be shocked. They haven't looked at, like, how much they've paid in fees, what kind of returns they've gotten for those fees. I mean, you should sort of logic. So some of the more sophisticated groups like GIC at Singapore and Norway, some of these groups have started to actually go and invest themselves. Or they've banned in infrastructure. When I started to work in infrastructure, there was a group out of Australia, a group of pension funds that got together and said, we're gonna do this. So, what's the name? I forgot the name of them, but they put together like maybe 6 pension funds in Australia. They started in Australia to do investing into infrastructure. And then they got strong enough and they said, okay, now we'll bring in other pension funds and we'll charge them, we'll get the fees.
That's
So-
something about Canada too, right?
Yeah, CPP, that's right.
理解
Right.
在教室
Yes,
进行
exactly, is actually Caisse de dépôt.
去那个
So
拉开的
you have
不知道
some of these
他们没
pension
说
funds saying, enough of
等
this
听就好了
nonsense, we're gonna go do this ourselves. But you have to be big enough to do it,
Right.
or you're paying other pension funds, which maybe
因为他要
you
看
better
那个
paying
河
like-minded
景
people.
要在那岛上看那个河景，就给咱们讲那个那几个
There
建
is
筑
that.。So, look behind the curtains.
Professor, did you see that the building in Kuala Lumpur is being built? The 1M building is being opened.
Well, the KL building, the first one was, that had, it was like the tallest building in the world.
对，这个 field
Petroleum. This is above that. This is
Oh, I
bigger than
didn't know that.
Yeah,
Really?
yeah, and it got stuck all these years because of the 1M the scandal,
Oh.
and now they're finally getting their first tenants end of this year. Crazy.
I love KL.
I love it. It's
It's
beautiful.
great there, yeah. Yeah, it's really cool. So, alright, so I found this and I thought, we didn't spend too much time on currency, but I just wanted you to look at this, that depending upon the currency movement, depending upon where you're coming from, will have an impact on your return. So the same currency will create either positive or negative impact, but based on where you're sitting. And that's really the message from this. You can look at this, but I think it's quite interesting. And CB did this. And then also, you know, we haven't discussed currency that much. But you can see the range, just the up and down in the bars here, the range of returns that are impacted, that currency fluctuation can cause in different time periods. So you can end up doing, like that Asia fund, that happy Asia fund, they could do really well. They can find the best investments, but if their timing is such that the currency moves against them and they haven't hedged it, which is expensive, like 200-300 basis points, maybe even more, it can really be a big problem. And I think we've discussed before that your hedging can be one of two things. You can either hedge the income stream or the appreciation, or both. Three things. So, and they have different prices depending upon how long you want to hedge that. But a lot of these investors will have an umbrella, their own policy of hedging so that the funds don't have to do it. Because the investors, why? The managers don't want to do that because it's going to eat away at the return that they would then get the promote based on.
So then you need to also consider the currency fluctuation, like limiting.
Yes, yes. And you could end up saying, you know, look what happened to the Thai baht. Like that was that whole explosion around the world. And so you might say, you're only supposed to hold the assets, because these are closed-end funds primarily. So you're only supposed to hold it for X periods of the year, 10 years, let's say, and you're getting down to the edge, but this currency is also moving away from you. You might need to go back to the advisory committee.
Oh.
And ask them, we want more time, right? I don't know.
He was wiping in the bathroom.
That's good. That works.
Last time it was like half an hour. I felt like I was having like an aneurysm at the end of it.
And the last time they informed us saying, you know, they're going to be running
Yeah.
some drills.
I had
mean,
such
I
a
didn't
headache
know,
by the
but
end of it.
I
It was
did
just-
want to say.
Yeah, keep on going.
He had a seizure by the end of it.
She said she painted it very leniently. She did.
Spruce
Like in class, she said.
No, they're at home.
Okay.
I can email you.
No worries. I just I'm gonna have some time after class that I have to hang around for, so I was just gonna work.
I haven't,
But-
I typically do those cases like the day of
Day of,
before.
yeah, no,
so-
same. I wanted to get it. That's alright. I have them. I think I have them at home.
Yeah, I'm on it.
Appreciate it.
Do you have a Sunday class this week?
Yeah, but you don't have to do any work. Like you
Oh, yeah.
just
Yeah,
walking us through it.
Because we have the
He wants us
presentation
to
on
start
Thursday.
Should probably start my.
It's just a test. Okay, all right, so currency. All right, oh, debt strategies. And we haven't spoken too much about them, but like we have this, like the Asia Happy Fund, they're actually funds that just do debt, okay? So, and in fact, some of them are replacing a lot of the traditional banks and insurance companies that have traditionally placed debt, and they're becoming very, very large, and that's what this is, essentially, a very large part of the sector. So this was, this is sort of a flow chart of how the world looks like in this investment management sector. So the investor, whether it's retail, high net worth, institutional, they go into these vehicles, fund of funds, they will fee, and then it goes into either direct listed securities, unlisted securities, and then into the actual asset. So it's sort of a vision of what we've been talking about. And the same thing here. The difference that you need to understand is that if you're in Europe or if you're in Asia, there are going to be different regulatory requirements in terms of how you structure these fund products and how you can actually set up like a limited liability corporation and what you can do and then holding the assets. And they're called SPDs. SPD is a special purpose vehicle. Here's some, so largest group of assets pension fund in the world, Japan, GPIF. Then you have Norway, so that's the sovereign wealth fund, Federal Retirement Thrift, which hasn't really been investing in a lot of these assets. And then you see there are a lot of ones that are outside the US. And then we've been talking about some of the ones in the US are California state teachers. And number 12, that's what I was telling you, our speaker next week, that's where he's been working. And he's gonna take us through his self-storage deal in Europe that New York State commented, which was their first European deal. And I think it was like $500 million, it was some huge amount. It was quite an interesting deal. So here you get a view in terms of where all this money that owns most of the real estate in the world is coming from.
Has this list changed much in the last few years? Just because I know Norway, I think, has
That's a
gotten a bit
great
bigger.
question.
And another Middle East country.
Okay, so the biggest change that's happened is, I think it was 2007, when sovereign wealth funds was sort of hatched. Other than that, it's pretty much the same. It goes up and down, one will move one little notch, up and whatever, but for the most part, it stays the same. It doesn't move a lot, other than this sovereign wealth change that happened. So in terms of the breakdown of institutional investors, it's primarily, the private sector pension fund, because it's also the older, this is what's going to change. There's going to be primarily public pension funds, which will have a larger piece of it. Insurance companies have a large piece, and you see the different foundations and endowments, and then the private wealth. And then by country, so US has the largest. Other, I think that other is probably, again, maybe some of the sovereign wealth funds that are distinctly out of Middle East and such, that are contributing to that in such a big way. So you have like ADIA, Abu Dhabi Investment Authority, and people like that have, we don't know how much they have, let's put it that way.
Is the US gonna go down though? Cause I know, I used to work with the federal government and mine was the federal pension fund, and they were gonna restructure my retirement before I quit, but that was gonna go down because they're trying to cut back on that, right?
Well, so, maybe.
Isn't it, they're trying to move from defined benefits to defined
defined
contribution? You have kind of the haves and have-nots in some of these plans where everyone before.
Well, that's the whole distinction I was saying before about the private companies, the IBMs and AT&Ts. The government, here's the deal. In the public plans, like these CalPERS and CalSTRS, it's sort of like a handshake. We're not going to pay you top dollar to work here. However, you're gonna get a pension plan. So unless that really shifts, I don't know. But that's been sort of the unspoken deal, that you get a pension plan. And you can get that, like my friend retired, I guess she was there 20 years or something. So let's say you start when you're 22, you could get a vested pension plan when you're 40 something. Right? And look at policemen, look what they do in the US. That's what they do. They leave much earlier. So here's Abu Dhabi. So they spend $58 billion to real estate. These are allocations to real estate. So So someone like APG does their own investing. They will go out and create a fund product for themselves, strategy, and work with local operators to actually invest the capital, and they just ignore investment managers. Not always, but in some instances. And the same thing with, CalPERS has been doing some of that a little bit, and Ivanhoe from Canada as well, part of Ivanhoe. Yeah, sorry?
This is just like an anecdote that I thought was interesting. So I have a few friends who work at Adia, and basically they're saying that now that like they're chasing yield no matter what. They're like buying like 9 cap, 10 cap car washes, like gas stations in middle America, like all across the country now. So just an interesting sort of like it's just interesting to see kind of how investment theses are like changing and shifting in terms of location and like yield chasing, stuff like that. So
do you know if they're going down into, because normally, because these, look at the they have to do big deals typically.
Yeah, exactly. That's why I was like.
But I'm wondering if they're doing, if they'll go, because you can get sometimes higher yields when you go down in terms of size.
Yeah.
Do you know if that's happened or no?
I don't know. I'm gonna ask that. Yeah, I'm gonna ask.
You wonder if it's portfolio too, because there's like random little guys. Like there's a couple of old like basketball players who own 75 car washes and 30 bowling things or whatever across certain areas where they lived, and all of a sudden that's worth quite a bit more than it might have been 15 or 20 years ago. But you can sell them all as one big portfolio.
Right. Right. Or sometimes it goes the other way.
Or you chop them all. Yeah. That too.
Yeah. Oops. So Asia has GIC, which is government in Singapore. NPS is Korea. Cathay is Taipei. Daiichi is Japan. Samsung is Japan. But they left out the other one, this guy, GPO. So I guess it was different. So that should be this one. So sovereign wealth funds. So this is where they invest. 16, 17, 18. So it's, again, it stays pretty much the same. It doesn't move around so much. But they have a pretty big allocation to real estate, sovereign wealth funds. And we've said most of the deals are in real estate are in North America, and it's the same thing for where most of the capital in the world is from. Right now, I predict that's going to change dramatically in China and India, but right now, this is how this is structured. And it's quite a difference. So, JLO is predicting $1 trillion in real estate to move overseas, to move cross borders. It's huge. $1 trillion a year in 1 year. We're moving. I think it was like 800 billion last year or something. So that is significant amount of capital. And this is what we were talking before about targeted versus actually invested capital. So this was, I just got this from this year, this is like second quarter of this year. And percent invested, so it's not that bad. It's really quite small, but it's still, if you look at the numbers, it's significant in terms of whole dollars. It's also interesting, 10.2 versus 8.7% invested. Asia Pacific to the Americas. Companies are pretty big. So sovereign wealth funds. So this is from the reserves, from the oil reserves from countries, and which they create these pools of wealth for themselves, to the point where I think Alaska, I want to say, actually distributes income from their, so they have a sovereign wealth fund, Alaska does. Some of the states in the US do, and they actually distribute some of the capital to the residents. If you are a permanent resident, you get a check every year for whatever it is, which is pretty impressive. So they are, so here the amount of money, as of June, this is 2015, this is a while ago, $773 billion, and all sovereign wealth funds was $7.1 trillion. So, not to be ignored. And then here, so this also is indicative of where this market's moving. And we have Asia at over 3 trillion. Victor, you with us?
Yeah.
Good. So over 3 trillion in Asia, whereas everything else pales in comparison for the sovereign wealth funds. So there are only 78 of them, but yet $7 trillion or so, which tells you a lot right there. And as I said, it's a relatively new phenomenon, 21 of the 78 since 2010. And they're way more aggressive, I would say, in terms of how they invest, the strategies that they do, I've seen, much more so than the pension funds. And the distinction here, since we just discussed about the pension fund, the distinction here really is the type of staff that they have. It's a much more highly professionalized staff. You'll see PhDs in economics sitting in some of these sovereign wealth funds, doing real analysis of portfolio and what we do.
Yeah.
And then natural resources is a big thing, and infrastructure. Infrastructure is huge for them too. But so when you're thinking about putting together a fund or a strategy, and you start to look at things like this to give you some guidance in terms of where to go. And here, so hydrocarbon is about half of where the capital is coming from for these different funds. So real estate from sovereign wealth. So 62% of them investing into real estate. It's huge. And I mentioned that these individual retirement accounts. So if you look at it, it sort of suggests a good question. This is a dynamic market in that you have a relatively new, very, very large portion of major capital coming into this market from these sovereign wealth funds in a big way, in an aggressive way. And then you have these large pools of capital from what was these corporate or private pension plans now moving into these IRAs, these individually directed kind of accounts. That is huge pools of capital. The problem with it has been you're not going to get them to sit into a. So if you have any of you have an IRA or 401k, the options are going to be a closed-end 10-year fund, which is too complicated. So what they'll have is these open-end funds. But the problem with the open-end fund is you have to be able to give back the capital if somebody wants out. So TIAA-CREF, which is now Nuveen, did do that for a while, but they got caught. They backstopped it with their own balance sheet. And like the global financial crisis, everybody wanted their money out. Should I look at that?
The thing's not flashing, so that's good.
Oh, you put your coat on.
Yeah, but it's actually stopped flashing, so.
Alright. He said. Whatever, you should have told us. Anyway, so there are ways of creating these, and JLL has this JLL Income Property Trust that's publicly traded. Any of us can go into this. And you can get in and out, but they limit when you can get out at times. So it's sort of like a semi-open, semi-closed kind of investment product. that's used for investing in real estate. If that becomes way more prevalent, that whole chart of the circle of where the capital is coming from is going to change drastically. And then all of a sudden, everyone's going to be able to have access from their individual accounts to invest into real estate. And that's going to be another huge flood of capital into the markets. So when you think about returns and where the returns are going, if you have a larger flood of capital that's potentially coming into that marketplace, what's that going to do to yields? Look at the returns that these guys have been getting. That's us in our individual retirement accounts, 2.2%. Nothing. Defined benefit country. So defined benefit is when it was directed by the corporations, and defined contribution is when we ourselves do it. Look at the difference. Part of it is you just don't have, most people don't have the financial background to be able to do this in any appropriate way. So it's moved the responsibility from the corporation and from the finance department making those decisions to the individual who has no expertise in making investments. And it goes back to when we looked at the demographics of all these aging, retiring people, and they're doing their own individual accounts, but yet they don't really know how. And the burden that's going to be, so you're moving the burden from the company to the country. Right? Because what are we going to do with these people that don't have money? They're retiring. Ultimately, we take care of them. Sort of.
To some extent.
Right. Okay. So here's CalSTRS, and again, one of the largest pension funds, if you know that. So now look what's happening here. So 2013 to next year, allocations from pension plans for real estate, 8.9 up to 10.6 in a few years. Significant. When you're looking at the trillions of dollars, 202%, that's a lot of money. That's still wanting to come down to this sector. And then, where is it coming from? Interestingly, look at that. EMEA versus, and then, well, Asia is pretty similar to the Americas. And again, we're pretty close in terms of margins. But look at the plot line, how much is below the plot line in terms of underinvested. So what this is all telling us is when we think about putting our portfolios together, where we're going to invest, and we would then think to do an analysis of where the returns are going to come from, we better be really careful because we're not going to look to see that cap rate compression just by the weight of the capital in the market alone. Look at the returns, what everyone's expecting. Target returns, 8.3%. That to me smacks more of what they have to get to meet their liabilities as opposed to what we think we can actually get from real estate. I don't know, I mean, we can start to look at, you guys did the different regions and you know what the returns are that we looked at. How realistic is this at this point? Target return for 2019. So look at this. So back in 2014, 300 basis points. So what's going to happen in 2023? Drop it on 300 basis points?
Makes you wonder in 2014 how many of those are like legacy investments from 2009.
Mm-hmm.
Another thing
Right.
to note.
That's right. But they're saying that the results are outpacing the target returns. So the actual was 11, right, so these are actuals versus, oh, and here's the averages in 5 years. So the actuals are pretty healthy. But again, I don't know how long that could last. So that's interesting. So, actual, yeah. So that's what I was saying. So the sovereign wealth funds, they had the highest. They have, well, for 18 they had the highest return because they take the highest risk. So it's not surprising. I don't know, do you think you can get 8.3% in look what they're targeting in the Americas, 9%. You think it's actual? Do you think we can do that? Maybe with some leverage. Especially because the leverage is so cheap now. So what's going to happen is ultimately it'll become a leverage play yet again.
Great.
It's a cycle.
It always is.
Yeah. Forget.
So
Short memory.
how is real estate doing compared to the index? We looked at the IPG index. It's actually done better. It's pretty good, right? These are actual institutional returns versus the index, which is just the reported returns. So 5-year average, 9.9%. That's why a lot of these institutions are running to real estate. That's what they look at. So the consultants show them, oh, look at this, 9.9 for the last 5 years, but where's everything going? And then it breaks down the types of investors.
That's where the keynote comes in. It's like past performance is not an indicator of future
Exactly.
whatever.
Right. It's also interesting, look at this. The 5-year average is 10.3 for the Americas. It's higher than Asia Pacific. And the public pension plans were below.
Is that because APAC has currency volatility though?
Could be. I don't know, it doesn't say whether or not that was currency neutral. But all, you know what, it would be currency neutral, because it would be in that country, because you can't, because otherwise you go nuts. So it has to be just a return in that country for real estate, so it's not looking at it from the US perspective, I don't think. And then opportunistic, so value add is where people are traditionally positioning themselves. And where do people want to go? North America. So, and emerging markets still small. So people are still feeling like they can get the returns in North America. Be it right or be it wrong. Well, that's what, I mean, if you look at a lot of the, like, Blackstone did this huge acquisition of these industrial companies. So, there's a lot of money journey. Okay, so this is institution investing outside of their, and it's what we said in the first class, there's not as much of a need to go outside of their home country in the Americas, whereas APAC, there hasn't been a huge sophisticated institutional marketplace. So it's growing up, it's happening, but it's not as fulsome as you would find in America, so there's just more opportunities. But in EMEA, it's, well, because it includes Europe, so that's why. And this is what, so here you go, so the closed-end private fund is what really has been the structure of choice for how to invest into real estate. And it just keeps getting larger and larger. This was important because we haven't really talked about this, but ESG policies are driving more and more, because especially these pension funds are very sensitive to their names in the news and such, and they have made a big point of looking at ESG as a component of their decision making of where to invest. And they looked, and there's now, I think I showed you, there's an index actually that's sort of monitoring all of this. I can't think of the name of it, Reggie, it's not, GRESB, GRESB is actually a group that's figuring out how to monitor and put numbers to this whole topic of ESG investing. And same. So transactions in different parts of the world. We haven't really spoken about individual transactions to date. So there's been just I guess a little bit of a slowdown, not much, a little bit of a slowdown, just total transactions across the world, other than in Asia Pacific, and specifically mostly in EMEA. That could have something to do with the UK and such, but it hasn't suffered too much with Brexit. So this is what's happening there. This is average capital rate, let's show 15. Cross-border recipient investment. Look at London. Contrary to what everyone's been thinking and saying, first half of 2018 was one of the largest places for capital to be invested in cross-border, in spite of, and maybe because of, because everyone thought that this is a great time to go buy there. And so lots of people around to go do that. Paris also was a surprise. With all the riots and everything that are happening there now. And look in first half of 2019. I was pretty surprised about that. Shanghai, look at the difference in Shanghai. It's quite astounding.
Yeah.
And Singapore.
Yeah, do you know what caused that huge jump?
You don't. No, they don't. Most liquid cities. Sort of what you'd expect. Oops. And so here's, okay, so again, Asia Pacific is the only place where volumes have gone up. And fundraising continues to be, and again, something you think about in terms of the amount of capital that's out there. Continues to, this is only through the second quarter of this year, so there's still more to go. And opportunistic, that's interesting. 2015, look at that, an opportunistic thing. Maybe as people thought they can get really great deals after the financial crisis. So, who's selling here? Who are these guys? What's going on? Purchasers, source of capital. Look at the size of the deals. What's happening? I hadn't even heard of this Therese, whatever how you pronounce it, portfolio. $2 billion. Shanghai, Sydney, Singapore, Frankfurt. So, all investment managers, in some way, shape, or form, AEW is strictly real estate. This is, AEW is a division of this French company actually, but it's strictly real estate. Blackstone does other things. Brookfield, primarily real estate, but infrastructure is one thing. Swiss Life, they do other asset classes, and Invesco does other asset classes. But these look at the size of these deals. So what's going to happen in the marketplace? These guys are gonna take over, get rid of all the medium and small guys, and you're gonna be left with a handful of groups that are just controlling the entire marketplace. I think I mentioned that Blackstone, I think, is the largest, I don't know exactly the right terminology, but they're the largest owner of like single-family homes or something in the US at this point, through that REIT that they have. Or I don't know if it's a REIT structure. But
is that why China's trying, because when we were doing our Senate, China, it was talking about China's trying to put those restrictions around that.
Yeah, that's probably right, because you want the competition, you want a whole different group of different types of management and such.
The Shanghai two of those were portfolios, and the one in Shanghai is just one asset. Like the Paris one's a portfolio, the Sydney one's a portfolio, the one in Shanghai is one mall, and they're similar values.
Is it?
Yeah.
It's one mall?
Yeah.
No,
Seriously?
It's a whole center.
Like it's one, but it's one. It's like one
It's
big
one,
block.
It's
like
one
it's
development, I guess.
But it's one asset.
Yeah.
One, yeah. Would it be one?
Like a mixed use building with a lot of different uses, but nonetheless it's one spot.
So it goes back to why, you might be bored listening to me about this capital raising and stuff, but it goes to the point of that. Because if they're raising, 10, I think Brookfield did a $10 or $15 billion equity raise for real estate. They have to put it out. They're going to go do this kind of thing for one asset.
It's also far
What
cheaper.
kind of risk is that you're taking? Let's go yell at some people. Yeah, logical portfolio. See, so now you have, look at these guys. These are more government, sovereign wealth kind of investors doing the same kind of thing. Yeah, this is also probably, one deal, 8 Bay East in Hong Kong. And everyone's jumping into the fray. So. So this goes back even, I predict. So here's some also, here, look at this deal here. $1.65 billion. This is 1285 6th Avenue, right over here. RXR, you know RXR? Okay, and China Life. That's really where the money came from. And $1.7 billion. It's much smaller. So, in terms of how you make decisions, this sort of goes back to what we started, all of what we discussed initially. We just saw that funds are the largest structure for owning real estate. So how do you start to select the fund from the investor's perspective is what we should be looking at also. So we have to look at the team, especially like that Asia fund. How many people do they have actually working and living in Asia? How many people actually did deals in Asia? They could have a portfolio, but it could be that that team left. So past performance strategy. How are they trying to find the deals? Yeah, because it could be you have these guys that just came out of school or whatever, they went to the right pedigree, but they don't necessarily have the relationships. It's all about, in any marketplace, it's all about relationships. What consultants, what is your consultant saying and how are they using consultants? Or are they using consultants? Let's see. And how the investors are looking at finding the managers. It could be through conferences, lots of different common things. But essentially they're looking at three things: the track record, the monthly track record, past performance, and the strategy. And they're going to have to ultimately compare fund to fund and manager to manager to see how everyone is actually operating. That's it. Oh, okay. So, it's a complex world, but it's getting smaller in its way because it's getting more concentrated and focused on very, very large deals because it's very circular. The investors need higher returns because more people are, so that's why we've looked at all these different pieces of the puzzle. More people are retiring. Returns have been very volatile in the equities market. You need higher returns to meet the requirements of the retiring people. So more money is being put into real estate, as we just saw, but it's not necessarily getting placed or committed to the way it needs to. And more capital keeps coming there and pushing into it, so then you end up buying buildings for over $1 billion for one building. Because the competition is so stiff. So you have to get it out and you need to try to get to some of the returns. But the returns have been pretty good to date, but we shall see.
I'm just curious, because I've been reading a lot of articles about how millennials are not saving and they're not buying, which causes a little bit of a macroeconomics problem in the U.S. because if they're not investing, they're also not going to be investing in these retirement pensions. They're also not backfilling the government jobs, which is a huge problem. So 30, 40 years from now, what does this market sector look like?
Well, a lot of that has to do with the fact that they have over $1 trillion in debt, in student debt. So hopefully in 30 years, that gets taken care of. And I don't know is the answer to you really, but I'm assuming that a lot of that goes away. And also you have Gen Z coming in, so I think that you'll have some other patterns that will start. And I'm seeing also, I've been watching this too, the millennials are moving out to the suburbs now, starting to buy houses. So you're starting to see a little bit of that movement. It's going to look a little different, I think, but there's still some movement that's been happening.
So maybe like a short period of it.
Right.
Also,
I
the
think.
cost of living so much higher now, even just as a percentage of income. So there's less money left over after, forget about buying a house, but just paying rent, paying your student debt and other things. There's not a whole lot left over to invest as a percentage of income relative to, maybe what some of our parents had when they graduated.
But my niece got a job, and I looked at what she was making, and I looked at when I was her age, what I was making, 'cause I knew what I was making, and it was just, I know I did the future, the calculation, and it was multiples. I would have needed multiples of what I was making, or she needs multiples of what she was making to earn that. She needed multiples of what she was making to have earned what equivalent of what I was making.
Plus, I think cost of living has grown at a much faster rate than
Right, and
income
salaries
has.
haven't.
Exactly.
So that's the real problem. So the answer is, I don't really know.
Make a lot of money if you figure it out.
I was speaking to her point about again college football. I just read headlines about college football kind of altering its compensation. Sorry.
While she's presenting.
No.
I was thinking.
No. This was just before class and more.
Okay.
Thank you for the clarification. So just before class, while I was taking the train or getting out of the train, college football kind of recently changed the compensation strategies for players, like for the young
The whole
people who are going to
NCAA.
get into college, which is going to increase like more home buyers, like at a very early age.
But that's
Thinking
not
like
compensation
that.
for
Very
playing.
small
That's
number
just
of people.
sponsorships. and,
Yeah,
like,
so they can get
likeness.
sponsored earlier. So I mean, there's a lot more money for those players
Sure.
in college. So that again
I mean, the other thing is
gives
it's-
a small boost to.
It's only the select top end of people, not everyone, right? It's only the really famous
So
guys,
that's-
and those are the guys.
So talk about like
and
each
those are
university.
those are the guys who are going to make $10 million
So
a year
talk
later
about
in the
each
NBA,
university.
so-
That's 40 plus homes sold in each university town.
I think the question really is, will people want to own homes?
Right. I mean, influx
I
of
don't think
like lots of influx of cash. I mean, that is going to be one of their downplays, saying I have to buy a
But if you
house.
look over history,
Yeah.
it is real estate. Wars are fought. I mean, real estate. It's a very fundamental thing,
Yeah.
and people want to mark their space. They want their space.
Yeah.
So, I don't think it's going to. There are definitely different versions of it coming up, but I don't think it's ever going to just go away. Because you're going to still have, like, look at what's happening now all over the world. The disparity of income, tremendous disparity, and the people that are in that 1% are still buying homes and real estate all over the world.
Yeah.
And that's what's fueling all of this. Look at the cranes in this city. It's amazing how much construction is going on here.
But to your point, if millennials don't change the mindset to buy homes and to widen the gap, right?
Maybe yes, maybe no, because what happened was a lot of wealth was created from the real estate.
Yeah.
It's a whole philosophical argument here too, about whether it's their mindset or whether it's a structural issue, and this is going into a whole political
No, that's
thing.
why, that's why I started out the answer by saying it's because you were somewhere around $1 trillion of
Exactly.
student debt.
Yeah.
So it's not even what you want, it's just like, oh my God. It's horrible. But, we'll see what happens. So, I don't know. But these are the things you need to be looking at and thinking about and factoring in when you're thinking about doing investing, whether for yourselves or for any company you might work for. Because it's all going to impact this, and you see that the amount of capital is vast. And then we look at the compression of what's happening between the bond market and the cap rate spreads. Watch that, see what happens there.
Yeah.
Because it's going to get less and people are going to, real estate's going to lose some of its luster, is what I think, that the returns just won't be there. Because it's, there's just too much capital chasing it, and people still have some belief that will appreciate because of the discount rate or something. But I don't see how. When you have, someone was showing me a medical office building in Flushing with a 4% cap rate.
That's insane.
Really?
Crazy.
Yeah. So,
You have to go outside for yields. You can't look in New York and the boroughs. No way.
you can find deals, but not.
It's harder. Yeah, we want to buy something at like 4.5. 4.5 cap, 5 cap.
Well, but think about it. So real estate was a 4.5 cap.
Yeah.
And now with interest rates so low.
Yeah.
So if you got
Like
as long as you got
3% money or
leverage
something. Yeah.
that was below the 4.5, so
Yeah.
it's positive leverage.
Yeah.
So now you're up to what, a 6, 7-ish, depending on how much you're taking out.
Yeah.
You can go do that calculation from that chart I gave you.
Yeah.
So that's not horrible.
Yeah, I guess so. That's true.
And if you have, and you say it's medical office, okay, so aging population, the whole story.
Yeah.
And you get
Yeah.
long-term leases.
Yeah.
Maybe there's some rental growth long term.
Right.
Yeah. But like, if you're looking at 3% money here, or like going to Tampa and buying like multi-family garden style apartments for like a 6 cap or something, like it's the same. You're getting this. Your rate of your like the cost of money is the same.
Right.
So I guess it's like this is kind of what I'm getting from this class. It's like I would just go down. I would just buy stuff from Florida. If my cost of capital is the same, but my going in yield is higher, maybe like my.
But I think that's no offense, I think that the going in cap rate
Yeah.
is such a misleader.
Yeah. Yeah, I guess so.
It's one moment in time, and you have to believe the seller that all the operating expenses and everything else are.
Yeah. All right. Yeah.
And also we predicting a healthy exit cap, saying
Right.
it. So
Right.
the Tampa apartment you said 6%. So if it is going to drop down to 4.5% in your hold period, well and
No.
good.
Probably
Well,
not.
but that would do
To
well.
stabilize
then he would
if
do
you-
well.
Then, yeah, then I'd do
Stabilize,
great.
put some cap back.
Right,
And
but then he would be very
Do
happy.
great. Yeah, I think that like exit caps on something like that is probably pretty stable compared to something in New York or like.
I mean, when I used to underwrite the banks I worked for, like, there's always this between reversionary and going in.
Yeah.
It's always
Yeah.
like,
Yeah. Exactly.
now,
Yeah.
with all of this, you look at it and go, oh, I'm not sure.
Yeah. It's true. What do you think about industrial?
I love industrial.
Yeah.
That's my favorite.
Why?
Because it's the most fundamental kind of real estate there is.
Yeah.
It's simple.
Yeah.
The big issue with industrial is you have to look at land pricing. Because it's inexpensive to put up an industrial building.
Yeah.
And it's simple to, and also, the other brilliant thing about industrial, you can get these triple net leases as
Yeah.
a landlord.
Yeah.
Doesn't get better, so.
So you like hands off, you lease it and you
Yeah,
walk
and then
away.
plus you can get, and what I like now about industrial is that it's all changing. Because now look at, even Amazon is looking at not the last 5 miles, but the last 1 mile.
Yeah.
So they're going to look at smaller spaces.
Yeah.
So there's the dynamics that are changing in that whole, and then you look at also the like biotech companies and how that's moving in, and they're
Yeah.
paying top dollar.
Yeah.
So you can get good credit for a very simple kind of building and very easy kind of operations.
Yeah. It's true.
So it's just
Good
it's a
business
land
model,
question.
yeah,
You
yeah.
always have to look at.
Yeah, they
well,
look at the basis.
what is,
land
no,
basis.
how easy is it for someone else to put up land?
Oh, okay, yeah.
To put up a building, to buy land.
Yeah, and just put up
And,
then
right,
put up
that's
another
the question
industrial
you
building.
have to look
Yeah.
at with industrial.
Yeah. Yeah.
Because
Okay,
it's so
that makes
easy to
sense.
build a building.
Yeah. Okay, that makes sense. Yeah. Huh.
But that's my favorite.
Yeah.
Residential? You wanna deal with people's houses, seriously?
Yeah. No. So,
And retail, well, we're talking about retail.
yeah.
And
Retailers.
office, office could be good, I like
Yeah,
office,
yeah.
but,
I mean, the office rents right
But
now in the
that's
city are
changing
just
also.
insane.
what's that?
Office rents right now in the city for like Class A product is crazy. Like
I know.
200, like Citadel leased like at 425 Park for like $250 a foot or something, like insane like that.
My friend did the debt down at, one of the pieces of debt down at Hudson Yards.
Yeah. It's crazy the rents
It's,
that they're
the
getting.
rents are through the roof.
Yeah, it's insane.
And she said the ones that came in early got good deals at like more north of $100
Yeah.
a foot or something, or $75 a foot or something. And she said they're gonna have such a shock when their leases come
Yeah.
up.
Yeah, it's crazy. It's,
I still don't know how people get over there, but whatever.
yeah.
Pile on the train.
Yeah. But have any of you been on that subway?
You go up like 7 escalators. You're like
It's
4,000 feet underground.
insane. It's like you're a mole.
I climb that every day. That's my station.
Is that that's where you live over
Yeah,
there?
I don't do cardio outside. I just climb those stairs.
That's so funny. That's an amazing. They did a great job.
Yeah, it is. I mean, it's functional throughout.
That project got more money than what the city was looking to give Amazon for Long Island City, and a lot of it was because of that station, because of the infrastructure.
We wonder if all the flack that they got for all the support they gave to Hudson Yards had anything to do with it too, right? It's a bit of a different political landscape now,
Yeah, we do.
giving money to a company than it was when they did the whole Hudson Yards.
Right, but no one
thing.
talks about it.
No.
But when Amazon came, it was,
Or just a different political landscape too.
right, it was years
Yes.
later, yeah. Yeah, look how long it took them to put that land deal together. But, I don't know, but I guess the offices are doing well there. So. Alright, good to go. Chat, okay.